Let's hear from our speakers for the next panel. Let us now welcome our moderator, Arthur Yuen from the HKMA, and our panelists, Jane Fraser from Citi, Colm Kelleher from UBS, Jean Lemierre from BNP Paribas, and Kanetsugu Mike from MUFG. Thank you very much. Arthur, over to you.
Thank you, Teresa. Good morning, everyone. I hope you have heard a lot of very useful information from the first panel. The first panel is about mainland China and Hong Kong. The second panel is more outward-looking. We'll look at the rest of the world. Indeed, the global economy is navigating one of the most complex periods in recent histories. Look everywhere, we have military conflicts in different parts of the world. We have climate crisis that is actually taking shapes in different shapes and forms depending on where you're looking at. We have all sorts of risks as well, including things like populism rising, potential sort of fragmentation in trade and financial markets, to name just a few. So these trends would have very profound implications for the global financial markets, in particular on all the indicators, future inflation pathways, interest rate glide path, etc. So it's good that we have put together a panel of distinguished speakers to help us to, first of all, tee up the issues and also try to go through some of the possible ways of navigating these very complex trends. So let's go, in the interest of time, let's go straight into discussion. Let me start with Jane. A very quick one. I try to stay not political, but it can't really be not political. Just a very quick one. What's your read of the US election outcome? And what does that mean for the regulatory landscape and deregulation agenda?
Thank you very much, Arthur. It's a great pleasure to be here with everyone. Thank you very much for inviting us all. So the election, I think one of the benefits is we had a decisive result and got immediate clarity. The agenda is largely pro-growth. Some questions around whether it will also be inflationary. And it's one where I think we know what is coming. President Trump's agenda is being clear, and he has a habit of doing what he says he is doing with a few flourishes here and there in the rhetoric. When we think about it, probably 4 T's, if you'll forgive me. Tariffs, taxes, the tapering of regulation, and tightening of inflation. And probably for this room, a couple of observations on 2 of them in particular. When we think about deregulation, the tapering there, we saw an almost immediate unlock happening with the election result. I'm sure when you speak to any of the banks, we saw a huge growth in our pipelines almost overnight in M&A, IPOs. Our sponsor clients are definitely back, and I would call it the big unlock that we've been waiting for a long time. It feels very real right now and is happening. A lot of the system have got very gummed up indeed. Similarly, I think for many clients, the regulation become pretty bureaucratic in industry after industry, and seeing that those getting unleashed, I think puts many CEOs in a good mood, because you need to be very nimble, very agile in this environment. And I think that again is impacting sentiment. And then the other theme is on tariffs, which obviously impacts this part of the world. I'd say that fortunately for here, fundamentals go much deeper than the policies will have an impact. But nonetheless, trade, it won't stop, but it's changing. And that's on top of a lot of the changes that have already happened as global lanes have altered considerably, supply chains, food, energy, technology, financial flows. You know, the last 3 years have seen a huge change in all of these flows. The dampening of some of the trade with potential tariffs will unquestionably accelerate some of the reactions that we've seen from that. I think the big questions off the back of the pro-growth agenda is going to be whether this is inflationary, what that does for rates, particularly at the long end of the curve. The market will probably have a reaction to that. And then I think many of us do worry in the long run about the debt. But as I say, the fundamentals are driving the US economy and some of the global economy go deeper than policies, and those fundamental changes will continue.
Yeah, thank you, Jane. You mentioned a lot of factors. If we go into fiscal sustainability, we might have to stay here until 8 o'clock tonight. So let's not stray into that. You talk about tariffs. That's the first T that you mentioned. I happen to know that 25 years ago you wrote a book projecting that in 30 years' time there will be no more geographical barriers to.
If anyone has trouble with jet lag and sleeping at night, I recommend the book. It'll solve it immediately.
But basically what you have projected is that the geographical barrier for businesses would disappear in 30 years. Are we actually seeing exactly the opposite here?
Look, it's easy to say globalization is dead. It's not. It's just changing tremendously. I think we're seeing everyone recognizing we've got to build up resiliency. But the flows around the world are pretty extraordinary. And we're seeing changing lanes, but we're not seeing a reduction in the different flows that are happening. So I think the headline there would be changing, but certainly not dead.
Thank you very much, Jane. When you were talking about the pro-growth agenda making CEOs happy, and I actually saw Sean smiling. So let me now next turn to Sean. Let's cross the Atlantic to look at the situation in Europe for now. So Europe has been facing a different combination of challenges, probably, if I may describe it that way. Relatively slower growth, far-right political movements, energy security concerns, increasing innovation gap with the US, to name just a few. So what's your take? What's your outlook of the European economy and the banking sector in the next few years?
Good to be here. Thank you for the invitation. In a nutshell, all of us around the world, we face challenges, including the US. Listening to your presentation, it could be as if there were no challenge in the US. There are, and Jane was very clear on this, there are challenges. All of us, we have massive challenges. Why? Probably because of COVID, because of monetary policies supporting people at the time of COVID and inflation, because of a successful development of globalization, which has brought a lot to many people, but also creates difficulties and requires adjustments. So all of us, we have these challenges, and this is what we see at the political level. Now, what about Europe? We have challenges we know quite well. One is cost of energy. And it has a lot to do with a war in Europe, which is the war in Ukraine. Cost of energy is a big challenge, which is being addressed. The second one is deepening what we call the single market. We have done this for long. We need to continue to do it. The third challenge would be, in my view, mobilizing in a more efficient way the long-term savings of Europe. May I make a remark on this? Because this is always forgotten. Europe is a continent of savings, and we export savings. Notably, we export a lot of savings to the US. Of course, a question, and that's good. We have no difficulty to do it. Nevertheless, we need to look at how to make a more efficient use of these savings for the benefit of investment in Europe. We have a fourth question, which is competitiveness of the private sector. Of course, this is a question for all of us, but may I remind you here that Europe has very strong and powerful global companies and a very strong network of mid-sized companies, which is one of the main assets of Europe, based on technology, industrial skills, and capacity to invest around the world. To that extent, Europe is probably one of the most open part of the world, investing everywhere. So when I look at this, I see that Europe is, I was telling one of my friends before coming here that I was going to speak about the roadmap. We have a roadmap. We don't have the 4 T's, but nevertheless, we have a roadmap. And the roadmap is based on fiscal sustainability. There is a framework for discipline in Europe. We like it, we don't like it. Sometimes we don't fully respect their negotiations and discussions, but there is a framework for long-term stability. That's a key point. And Jane made the point the opposite way. That's a discussion we need to have across the world, which is sustainability. Then we have a framework for green sustainability. We are very committed to it, and Europe will stick to it. We need it. We need it for the planet, and we need it because we need to save and produce energy a different way. So when you look at this, and I don't want to be any longer, I think Europe is on a strong footing. There are elections today. There are elections in Germany, there were elections in France, there were elections in the Netherlands, Belgium. We know well the debate. This is part of democracy, this is part of life. But from my client's point of view, I think they have a clear perception of what should be done and what is going to be done. So, yes, we have challenges, like everybody, we have challenges, and this is being addressed step by step based on strong savings, long-term stability and sustainability, and willingness to grow. Now, I will add simply one question. There is an important question for Europe in the next weeks or months, which is war in Ukraine. And the situation of Ukraine, of course, may have a big impact on Europe. Will have, whatever happens, Ukraine is very important for Europe. It's the door of Europe, it is Europe. So this is a big challenge we have. I hope it is a common challenge.
Yeah, thank you, Sean. You talk about sustainability. Indeed, actually, Jane also raises a similar point about fiscal sustainability in the longer run. We can actually circle back to this issue later on in the discussions. But in the context of Europe, isn't it also true that similar questions could be put to you that I put to Jane? Are we seeing a more fragmented world in terms of both the trade system as well? Are you seeing any fragmentation in terms of financial markets?
Oh, listening to you, I thought you were going to raise a slightly different question. Are we seeing a more fragmented Europe? But you didn't raise that question, so it's easier for me.
Well, you can address the fragmented Europe question as well if you want.
No. You ask the question, I give the answer. No, fragmented world. Of course, there is a risk of a more fragmented world. But we can take this from different perspectives. I'll try to be constructive. We have, step by step, created a unified, is not a more global world, which has brought success and benefits to many people in the world. Nevertheless, Today, we see that the success brings question. And the risk is that the answer to these questions is protectionism and fragmentation. And we have to work on this. This is possible. Let's be clear. Trade is a matter of negotiation. Of course, there's noise, there are threats, that I can understand. This is part of life. But trade should be a negotiation, a discussions. People should sit down, compare notes, and try to find agreements. By the way, this is what's going to be done. The difficulty is not the end result. The end result will be an agreement, because otherwise it would be terrible for each of us, and nobody has an interest in shooting in their own foot. The difficulty is how we get there. And of course, the way we do it can create a lot of noise, perception of difficulties, fragmentation on trade and on finance. And it's a common question for all of us, which is to try to avoid this and sit down and try to make concessions, because all of this is about making constructive compromises, helping people to continue to work and grow. And there are solutions. On trade, it's about tariff, it's about quota, it's about reciprocity, it's about timing. We know the parameters of the discussion. So wisdom should lead to this type of approach, and that would be much better than antagonizing.
Yeah, thank you, Sean. We'll come back to sustainability later, okay? Again, let me turn to this part of the world first before I get back to Colm. Miki-san, Japan. Japan has definitely been one of the top interests for the financial world this year for various sorts of reasons. By the way, Hong Kong people like Japan. They travel to Japan over weekends. That's why they also care a lot about where the yen is heading. So can you tell us a bit about the Japanese situation in terms of the asset market? And also probably if you can share with us your perspective on interest rate glide path going forward?
Well, thank you for invitations. I'm very pleased to be here. Well, while, as Jane and John mentioned, we are confronting with the common challenges, but having sit together with the friends from the United States and Europe remind me that Japan economically rather uniquely positioned, as whilst your central banks are making a very effort to how to manage inflation, Bank of Japan has been a struggle for many years to fight against a deflation. Well, Bank of Japan has raised the interest rates for the first time in 17 years in an effort to reverse the deflationary mindset, which persisted for decades long. So that brought the Japanese economy back on a modest growth. That is one of the big reasons why Japan attracted many funds and the capital flows to divide every asset in Japan. So for that point, I would go through just the 2 points. The first one is undervaluations of Japanese assets. What I meant is that the capitalizations of a stock exchange market has been below the level which achieved in the late 80s. It's the first time in this year's July that which surpassed the Nikkei index of 42,000 yen, which is a historical high, but achieved for the 3 decades after. And yet, the PE ratio is around 15 to 60 compared to the 30 times of S&P. So that means the valuation of the yes, still low, relatively low. And looking at the other asset class, like a real estate, the total valuations of real estate in Japan has recorded the $17 trillion in late 80s. The current valuations of a real estate in Japan is just $9 trillion, just half of what they achieved at the peak at the late 80s and 90s. So that shows undervaluations of Japanese assets, and also the Japanese yen is weaker right now. The second point is improvement of corporate fundamentals in Japan. The companies listed, which comprises topics indices, recorded their historical high net profits for 3 consecutive years. But that said, well, as I mentioned, PE ratio is still relatively low, and as the initiatives of corporate governance reforms is progressed, Japanese executives become more conscious of shareholders and the capital efficiency. That resulted in the unwinding, massive unwindings of cross-shareholdings, and the total annual dividends was doubled over the past 10 years, and also our share buybacks was increased by 10 times over 10 years. So that shows how corporate fundamentals of Japan has improved. So that would possibly attract more. And in fact, having been in Hong Kong, I hear from my friends in Hong Kong who says, I'm buying a house in Niseko or in Tokyo. So you already know all these facts. And about that, you asked me about the perspective of Bank of Japan's interest rate policy.
Yeah, interest rate policy.
Okay.
What's your take on the outlook?
Okay. Well, our house view is the Bank of Japan may raise the interest rates once more by the end of fiscal year. I mean, by the March next year, and twice more by March 2026, making the policy rates to a neutral rate. In Japan, that is considered to be a 1%. So there is some people who express a concern that whether the Japanese economy is durable even for that level of interest rates. I would say that that wouldn't be much of a trouble for the Japanese economy, because the corporate sectors, the many corporates are still decreasing their net borrowings, and even the SMEs, which is considered to be financially vulnerable to a rate increase, has some multiple 10 times the interest rate coverage ratio, which is the highest in the past 30 years. And the household sectors, on average, deposit of household sectors is the 10 million yen more than they're borrowing. So overall economy is quite durable for the rate increase for that level.
You did mention that this is your house views. That's your house views.
Yes.
Do you care to share with us your
my view.
personal view?
Thank you very much. Well, I think our rate increase will be more accelerated because there is a more inflation pressure, especially after the change in the leadership in the many countries, and they put more effort in the economic stimulus. That would put some more pressure on the inflations, and that would impact on the Japanese yen rate, which is still already up to the 150, 155. That is very weak. And the Japan economy is not that export-driven. Therefore, weaker yen would have a negative impact rather on the Japanese economy. So that would possibly, make some change of the mind of the Bank of Japan.
Yeah, thank you very much, Miki-san, for your sharing also your personal views on interest rate glide path. Colm, let me turn to you. So UBS has always had a very strong presence in Asia. Given all that we've heard, what's happening around the world, the very complex landscape, what's your take on the outlook for the APAC region in terms of growth, in terms of some of the complexity that we're seeing?
Well, first of all, thank you for having me here, and compliments to the Financial Secretary and Eddie for the growth of this conference in its third iteration, which is significantly heftier than it was when it started. And also, thank you for asking me a question where I'm not going to upset my good friends Mark Rowan and John Gray. Specifically in wealth management in Asia, we've been here 60 years, and in China we've been here 30 years. APAC represents the largest pro rata growth in billionaires. You're looking at an asset pool of about $3.7 trillion. In up to 2030, you're going to see a wealth generational transfer of almost $6 trillion. And China over time will be a multiple of that. So we see this as an incredibly strong area for what we do best, which is wealth management. But also the interesting thing about the APAC region, unlike the United States, is that the interconnectivity between investment banking and wealth management is very strong, mainly because the number of global family offices, owner proprietors, and so on. So we also have a very strong investment bank in this region, supplementing our wealth management business. Clearly, the demographics are incredibly strong. We have a two-pronged growth strategy for UBS post the Credit Suisse acquisition. Asia is a major fork of that. The other, of course, is our US strategy. Specifically, we brought Iqbal Khan across as president to Asia. He actually runs our global wealth management business, which is underscoring just how important we view this region. So we will continue to invest here. We'll continue to grow. We heard today from Chairman Wu and the head of the other regulators and the vice premier about the opening up of markets. I think China and Hong Kong are ahead of Europe on its opening up of markets, capital markets access, and should be applauded on that. And they see this as an issue of strategic autonomy. So that actually plays very well into a firm that represents a wealth management business.
Thank you very much for that. But against all those backgrounds of increasingly complex landscape, are there any risks that you think the Asia Pacific region should particularly watch out for?
Well, you know, one of my mantras is you only worry about what you can control, and I cannot control tariff risk and global thermonuclear war or whatever it might be. So I think in terms of where we are, Asia itself has very good core growth, 4.6%. Even if you look at the tariff effect on China, which will significantly affect Chinese growth, we think China can do quite a lot in terms of remediating that. And also, as we've heard from certain commentators, there has been, and I totally agree with Jane on this, there is no end of globalization, but there has been a strengthening of cross-regional ties, which I think will mitigate some of those effects quite considerably.
Thank you very much. There is another question that I want to put to you. It has nothing to do with the complex world, but with complex merger. You have actually had a front row seat of the most complex merger that financial history has ever seen. So far, so good? Anything that you can share with us?
Let me spend 2 hours on that. Number one, I want to make it very clear that resolution would have worked for Credit Suisse, but it would have been very messy. The theory is that G-SIFI banks do have resolution plans, and can they work? The risk is that resolution by definition is contagious and can be a contaminant. So obviously having a private solution is always better for these G-SIFIs should these things happen, and they may happen again. The only note of caution I would give, and we saw this in 2008 with another well-known American bank, if you step in to do the right thing, which in our case was bailing out Credit Suisse and stabilizing the system, what you can't have is post hoc penalties over and above what was agreed at the time. So I think a lesson for global regulators must be, if somebody steps in to do the right thing, that is the right thing, and it should be appropriately rewarded. Secondly, what we found out about Credit Suisse was that this was not an issue of capital. I'm ranting now, Arthur, so you're to forgive me, right? This was not an issue of capital. Global SIFIs are more than well capitalized enough, and we saw that in March 23. Please, regulators, do not look at yesterday's battle. Look at the issues we need to focus on. Global liquidity framework, access to collateral, and most importantly, what is the role of the regulator in addition to shareholders and the board at looking at the viability of a business model. Having said that little lecture, the integration is going very well. We've actually started doing our technology and client migration in Asia first, and it's working very well. That's what we were most worried about, not the actual rundown of the liabilities and the mark-to-market of what we acquired, but it was actually the integration, and that is well on plan.
I'm pretty sure that, because I run the banking supervisory function in the HM, I'm absolutely sure we're looking at the right thing.
No, you are. It wasn't aimed at you.
Yeah, thank you very much. We do have a little bit of time left. I come back to the question of sustainability. I need a brave panelist to answer the questions. Should we be worried about fiscal sustainability, whether it's the US or other parts of the world? Jane?
Yes.
That's it?
If we look at, we've got a decade of building resiliency, be it in defense, be it in the green and the affordability of sustainable green business models and societies. And the list can go on and on. That's a lot of expenditure. So I think the challenge becomes on fiscal deficits, there's a numerator and there's a denominator. The numerator is growth, is helped by that, and then there's obviously the denominator, which is very hard. I think any one of us in the room would say it's easier to spend money than to save money. So I think this is going to be a very challenging time.
Thanks, Jane. Any other comments from the panelists? No, no. It's fully sustainable or what? Jean, you pick up the mic.
No, but you mean sustainability from which point of view?
Fiscal.
Because for me, sustainability may also mean green.
Yeah. Huh? But let's do a fiscal first.
So I can take the two. No, on sustainability, I've made the point. You know, Europe has a framework for this, to be careful and mindful about the fact that there could be mistakes. Not easy to respect, you know, the political difficulties in the two sides. In Europe, some may spend too much money, some may spend not enough money. And we have the debate, that's very well known. But at least there is a framework, and I think it's good to have some limits, some framework about what we need to do. And this is to be monitored very, very carefully. I agree with Jane.
Since you're interested in green sustainability, I have to say that I was in Europe very frequently for Basel Committee meetings, etc. I do sense recently some concerns in Europe about the speed of green or transition or whatever. I can sense that there are momentum sort of waning off a little bit, if I may say so. Do you sense that, Sean?
No, I don't share this view. We have to be specific. I think you are right on perception by people, by the clients, the man in the street. Okay. They think it is new, difficult for them. It requires money and loans, and it takes time. On that I agree. From the business point of view, you have a debate in Europe raised by the car industry. And it has to do with the 2035 year in which normally we should stop selling new thermal engines. So there is a debate about this, which is a debate about the adaptation. Then there is another debate, which is the reporting of what we do, which is very detailed and probably will be reviewed to a certain extent. But if you go to the substance of the question, which is, do we need to invest and prepare to a different world? I think there is no doubt. That's the key point. And when I speak with clients in Europe, all of them are embarked into the story. By the way, quite the same in the US. You know, we have to make a clear view about this. I think the corporate sector has understood it is needed. Because, once more, because of the planet and because of their own needs. And they want to save money and they want to do well. So from a business point of view, with the corporate sector, we do not see any reluctance, on the opposite. But there are, yes, questions on the points I've made, but not on the substance.
Thanks. And any other comments from the other panelists on the green agenda? No? Actually saw the next panel lined up over there, so that's a cue for me to wrap up this panel. But let me just wrap it up by asking one very quick question to all the panelists. In the next 12 to 18 months, if I ask you to pick one challenge that we should be worried about, what should that challenge be, and which business line would particularly be impacted? Should we start with Jane again?
The one that keeps me up at night is cyber. I think the combination of fraud, AI, cyber, we're seeing cyber getting democratized. There are multiple different bad actors out there, and you have to get it right every single time to stop it, and they only need to get it right once.
Yeah, thanks. Colm?
Well, my immediate concern over the next 18 months is finishing the integration with Credit Suisse. But, and I agree on cyber, and I think AI is a longer term time frame, but we can argue about that. I do worry about where pockets of risk are building up outside the regulated banking system, and whether you as regulators are monitoring that and looking for that. And that's not a criticism or a need for more regulation, it's a monitoring issue. And an example of that would have been what was happening in crypto and how we're managing that risk.
Thanks. Sean?
Not to repeat what was said, I fully agree with what was said. I would mention two. Definitively technology, cyber, but technology, as a whole. It's a key question for all of us. And of course, my second point I monitor very carefully is Ukraine and the Middle East, which may have a big impact on Europe, but a big impact on the world. And the way it is dealt with, agreements around this or not, this is a very painful, difficult situation for the people and for each of us. So Ukraine and the Middle East.
Thank you. Mikei-san?
Well, after three persons mentioned about risk, I was supposed to say something different. That is challenging, I would say. Well, then I would say monetary policy in the various countries is the one we have to really look into. Because in the late 80s or 90s, the developing major countries, central bank decide the monetary policy on their own. So there is a difference in the monetary policy across the countries. Likewise, the 80s, Paul Volcker maintained the very high interest rates. German lowered the interest rates. The recessions following the Gulf War, United States lowered the interest rates, while the German raised interest rates due to the inflation pressure following a reunifications. But since 21st century entering into, the globalization synchronized economic cycle of many countries, and that resulted in the alignment of a monetary policy. This time, as I mentioned earlier on, Bank of Japan is trying to raise the interest rates going forward, whilst the US and the European central banks lower the rates. So this is the first time that monetary policy is divergent between Japan and US and Europe. What kind of the effect that would have on the economy and the financial market is something we have to see.
And also that might have an impact on cross-border fund flow situation as well, right? So thank you very much. We are right on time. Let's put our hands together for the distinguished panels. Thank you very much for generous sharing.